I think there's a bit of a misnomer in the sense that, the only interest rate that the Fed really controls is the overnight rate. The Fed does not directly control 5-year bond yields, 10-year bond yields, or the long bond yield. The Fed controls the overnight rate, and there's no doubt that expectations on Fed policy does have an impact. But what really strikes me is that the question always comes back to, is the Fed right? Is the Fed screwing things up? And nobody talks about that the real reason why interest rates out towards the middle and long-term part of the bond curve comes down to fiscal policy. I mean, this is the beauty of going to high school and learning about Sir Isaac Newton and the reality that every action has an equal and opposite reaction. Why would anybody think that we could stimulate fiscal policy to the extent that we're going to run trillion-dollar deficits with a 3.7% unemployment rate and not have a reaction in interest rates, irrespective of what the Fed is doing? So it's interesting that the whole narrative now is on Jay Powell, Lorraine Mester, and the Fed. No consideration given that if you're going to increase the supply of bonds to fund these fiscal deficits, you are going to have a reaction in interest rates out the yield curve, no matter what the Fed does or doesn't do. And it's interesting to me that nobody talks about this. It's not really all about the Fed. It's really about, to a large extent, fiscal policy and the dramatic degree of stimulus at this late stage of the cycle at a time when we were clearly at full employment.
So take that apart for us. Perfect. Take that apart for us, Ron. I mean, David is saying that the issuance of $1 trillion in extra bonds means that the issuer is going to have to pay more to attract investors. That price is the interest rate.
Of course, as David North is going to go back to, kind of Econ 101, it's ceteris paribus, all other things being equal, that is true. The Fed, by the way, does control longer-term interest rates insofar as part of its quantitative easing program was driving down long rates by buying bonds.
The bonds.
Now they are net sellers. So in addition to the fiscal stimulus and the rising deficits, they are not the buyer of last resort. So they, too, are pushing supply into the marketplace, which could, again, all other things being equal, push rates higher. But we have a slowing global economy, and we've had these little financial hiccups along the way that has been compressing yields even as they're trying to break out to the upside.
So you've both identified other slugs of reasons why
Chinese selling over the last 3 months.
Why interest rates are going up. So if the Fed funds rate draws so much attention, why does it draw that much attention with respect to what it means for other rates out the curve?
Well, a lot of other rates are pegged to Fed funds or other short-term rates. So whether you're talking about LIBOR, which kind of exists, kind of doesn't. Yeah. And so the cost of capital for business will go up automatically as the Fed normalizes interest rate policy. And if you have a lot of debt that's short-term in nature, or if you have adjustable rate debt that has to reflect increases in interest rates, that could present a headwind for the economy and also, for business more broadly speaking. You also have the possibility that we're at peak growth, peak earnings, and that higher rates at this juncture make it even that much harder to grow.